All you need to do is look in the news, look on social media, look wherever you get your distracting distractions, and see that when it comes to investing, the big subject is the fees that you pay. All you need to do, honestly, there's so many calculators that say, oh, if you ditch your advisor and do it by yourself, this is how much you will get in the future. The
Yeah.
problem with this is it doesn't tell the whole story. All you need, like honestly, here's what it works out to, Richard. Investors are happy when the markets are up, and they're sad when the markets are down.
Yep.
This data tells us also that investors on average buy into the markets when they're up and sell out of the markets when they're down.
Yes. We know that for a fact.
Mhm.
Okay. Um, Delbar and Delbar has a tool, and we subscribe to it, called the quantitative analysis of investment behavior. And it's not just an anecdotal little tale that they tell. They're talking about hard data. And what they've done is they've dug deep into the investment industry to find out that, okay, what do investors and investment advisors do when the markets are down? And they found out that actually the market is selling assets at that time. And they're actually, we know we're supposed to buy low, sell high, but during down times, investors are, for instance, in equity funds, when they go down, they are selling their investment funds. And then the markets are going up and they're at the very peak. And that's the time when people are putting the most in. So they're buying high and they're selling low. We know this to be true. This isn't just a tale we tell, it's based on hard data,
Now,
right?
an example. With everything that's happening in the world right now, how do investors react to the volatility? So, for example, we don't know what's happening right now, and everyone is kind of reflecting that.
When we don't know what's happening, and it goes back to what happens to a person who's oxygen deprived in a
Okay.
vacuum, they start hallucinating.
Hmm.
And when we don't have information that we need to make decisions, and honestly, when we don't have a guide by our side who's like a trusted advisor, somebody who actually knows how to navigate these waters, we will hallucinate and we will gravitate towards whatever is fed to us on social media, which is designed to trigger our attention. And ultimately, we will make a bad decision on that. It's
Hmm.
inevitable.
Yeah.
Okay. Because we're being distracted. Our attention is being day traded, and I don't like it, Matt.
Yeah.
It angers me because eh,
People
people
are
have
being
lost
misled.
people have lost the farm based on somebody day trading their attention,
Hmm.
and it angers me, and I
Just
don't want that to happen. Right?
let's go into that. Let's go into that before we go into our conversation, because I think it angers you because you've seen many people's hard-earned wealth destroyed as a result of a stupid emotional decision that they were misled on.
Yeah, many, too many times. Let's put it this way.
Yeah.
Right?
So
And
this,
it's not been on our watch.
yeah.
Okay, like we've had people who have, unfortunately, we lose the odd client, and very often they will go in a direction that somebody's day trading their attention. And again, we've seen people lose the farm because of that. It's tragic. I hate to see that happen. Right?
So, for the purpose of this conversation, we will be referencing two different documents. We'll be
Hmm.
referencing the Dalbar QAIB, which is the quantitative analysis of investor behavior, but we'll also be referencing the Vanguard group published and a study called the Advisor Alpha. Do
Yeah.
you want to talk about that quickly?
Yeah, for sure. Well, we kind of touched on the QAIB report a little bit, and okay, so Matt, I'm pulling up the Dalbar QAIB, Quantitative Analysis of Investor Behavior report, as at December 31st, 2021. And what it tells us here is that in the 1 year period of 2021, the calendar year, the Standard & Poor 500, that's the top 500 stocks in the United States, returned 28.71%. That was an unusual year. Don't expect that to happen every year, okay? Like, it's, come on. I know a lot of, some generations, especially younger generations, have an experience like that, and their expectation is, okay, so we're going to do that no, we're not going to do that every year, okay? That was an extraordinary, different year. But in that same year where the S&P 500 did 28.71%, the average equity fund investor who invests in those same stocks did 18.39%. Holy cow. That's a 10% difference. Are you kidding me? Now, over a 3-year average, the S&P 500, now this has been unusual during this pandemic, is stocks actually went up phenomenally, especially tech stocks. The S&P 500 averaged in the past 3 years ending December 31st, 26.07%. Again, this doesn't always happen. The average equity fund investor, 21.56%. That's a big difference, Matt.
Yeah.
And over 5 years, the S&P 500 did 18.47. The average equity fund investor did 14.8. And on and on and on. If we take a look at a 30-year time frame, which I consider like a good data set, 3 decades. I don't care about a year, 5 or 10. I don't.
Mm-hmm.
I care about long time frames. Over a 30-year time frame, the S&P 500 averaged 10.65%, which is consistent with what it's done over the past century.
Mm-hmm.
The average equity fund investor, 7.13%. That's like 3.5% less than the benchmark. Now, does this mean that everybody should just go out and buy the S&P 500? Well, technically, if people did that and just stuck with their guns, they would probably have a good experience. But people
I want to
don't
interject
do.
here.
Yeah, what?
Didn't Warren Buffett instruct his estate to just put everything into the S&P once he was gone?
Yeah,
Or something
absolutely.
along those lines.
Yeah, and he also had a bet with, the top hedge fund managers who are the masters of monstrous fees and, trying to guess the future, which they can't. Okay, but the thing about what Buffett said is that, yeah, it's true. But Buffett is also known as the man who's got probably the best investor discipline in the world.
Yeah.
Like, he's got an investment philosophy that is rock solid and they don't deviate from it.
Mm-hmm.
I got to be honest with you. Most people without professional advice don't.
Yeah.
Okay. It is hard to maintain the discipline and grit that you require to do the things that you don't want to do, which is stay in the market when it's down.
Yeah. But
And
here's the thing.
don't get too excited when it goes up either. Okay.
Yeah. When we go back to that Warren Buffett example of putting everything into the S&P when he's gone, people look at that as the Bible when it comes to investing and the whole reason why that argument works. The unfortunate thing is they don't realize that he has some insight. He has a lot of insight. The reason he makes it so clear and specific and achievable is because he knows that people are going to screw it up.
Mm-hmm. Mm-hmm. Well, and the thing is, if Buffett completely followed that advice, he'd do the same thing with Berkshire Hathaway, which he doesn't.
Mm-hmm.
He has got the ability, with their monstrous cash float, to decide that this company in our portfolio gets more cash this year because we see a great opportunity. We're going to shift some to that direction, and we're going to shift some of our float in the other direction because we see a great opportunity, for instance, to buy Burlington Northern Santa Fe.
Yeah.
Right. And what a great investment that was, given that trade routes are being reconfigured to go like north-south and North America and South American stuff rather than across oceans. What a great decision that was. But that's an aside.
That's an aside.
That's an aside. Absolutely. So yeah. The best financial professionals actually do double duty as behavioral financial coaches. We
Yeah.
do it all the time.
Yeah.
Our top clients, our most rational clients, when the markets take a dip, is like just calling in, making sure we're doing the right thing. We're doing the right thing. And we've been through this before, and we've gone through these trials with clients time and again, and we still get their phone calls. And actually, we don't wait for that. We often reach out to clients right away and just say, listen, we're good. We're in it for the long haul. We need to stay the course, continue to rebalance, and continue to maintain the discipline.
Hmm.
And you were talking about the Vanguard study.
Yeah, but before we get to the Vanguard study, I think the QAIB specifically points out the prudence of a long-term buy and hold approach, right? The
Yep.
folly of measuring investment success just against the benchmarks, um, the awareness of the most common behavioral influences,
Yep.
lessons from the past, and the importance of investing assets as early as possible.
Yes.
So those are
Yep.
some things that are in this. Now, moving on to the Vanguard Advisor Alpha. This is an interesting one because they've quantified how the rate of return an advisor adds to the overall longevity of a client's wealth. And it's about 3%.
That's right. Yeah. Yeah.
People who work with a professional advisor on average make about 3% more than people who don't.
And have you broken down as to why that is?
It goes into many components, but here, let's go into a few of them.
Yeah.
There's portfolio construction, there's
Yes.
wealth management, and the biggest player of it all is that behavioral coaching, as we were talking about.
There you go. There you go.
So let's break it down further. What do we mean by portfolio construction? So within portfolio construction, we mean picking suitable assets, diversified assets, um, asset allocation, cost effective implementation. So that's really where expense ratios come in. Managing turnover comes in there, cash drag, all those different components that we've talked about in a previous episode, and asset location. So that's within portfolio construction.
Yep.
Within wealth management, such strategies are like rebalancing, a spending strategy. So, for example, tax efficient withdrawal plans. And the big one within behavioral coaching, advisor guidance adds about 1.5%.
Well, in both studies, that's the commonality. The Vanguard study as well as the Delbar study, it's crystal clear that, yeah, okay, if you buy an exchange traded fund or a mutual fund, you're going to have varying degrees of fees that apply, but not to the degree of the differences between the Delbar investor returns versus the S&P 500 returns. Those are huge differences. That comes about, those differences come about because of differences in behavior, um, i.e., bad investors behaving badly. Okay, that's where it's coming from, right?
Yeah. And I think the important thing, and we'll keep hitting home on this, is professional advisors can help investors be mindful of their emotional responses, even if
Yeah,
it's
for sure.
someone to just bounce things off of, and being maybe like not a gateway, but like being a person that's there that they have to talk to in order to sell their assets.
Yeah, yeah,
Now, as advisors, we can coach our clients, but ultimately we do have to listen to them, and we hope that in many cases they side with our data and our logic and our reason. But sometimes that doesn't happen, right?
for sure. You know, like during the past few years of the pandemic, the markets have been driven by very large growth stocks, and many of these growth stocks were trading at, 30 to 50 to 1 to 100 to 1 price earnings ratios. Many of these companies actually weren't even earning money, and people were buying them just because, whoa, wow, technology, man. Well, we were doing the same thing in the late 1990s, and look what that did in March of 2000. I'm not saying it's going to happen again because I think the tech market is a lot more mature, but we cannot tell the future. We have to go on investment fundamentals. We have to go on data, not on what did well. I tell you a little tale about a stockbroker friend that I have who used to work with a big brokerage firm. And when we were talking about, reinventing his investment approach, I asked him, I said, so let me get this right as a stockbroker with this firm. You would get a buy, sell, hold sheet from research that basically said, our research says you should buy this stock, sell this stock, and hold this stock. Right? You get that every day. Yeah, we get that every day. And then your marching orders are to go to your clients and say, well, Mr. Client, I think we should be selling this stock and buying this stock, and this stock we'll leave alone. Is that kind of how it worked? It was absolutely how it worked. And what was the outcome of that? Well, we'd collect commissions every time we trade. Okay. So a little bit of a conflict of interest there, right?
Hmm.
Yeah, just a little bit. So it's a model that just doesn't work. It's a
Yeah.
model that just doesn't work.
Now, people might be asking themselves, do I need professional advice? And we will address that conflict of interest up front right now because we are heavily biased towards this. But at the same point, we have seen the benefits of it in our work with the clients. But there's one thing that I really wanted to emphasize. You need to work with a qualified, independent advisor who actually has your best interest at heart. Any thoughts on that?
The standard configuration in an office is a desk with like a P-top kind of a thing where the client sits on one side and you're on the other side. And I think that perfectly portrays the institutional client advisory relationship, where the advisor is working for an institution which has quotas that say you must bring in X amount of revenue per month, or you might as well just hand in your papers, your resignation paper, because this isn't going to work out. Okay. It's something that's driven by a relationship between a company and its employee advisor. And the client is there to fulfill the mission of the shareholders, which is to drive earnings. An independent advisor turns that around and simply sits on the same side of the table as an advocate for the client. And we call that a fiduciary responsibility. When, as portfolio managers, and you and I are both portfolio managers, our job is we need to give investment advice. And I will extend that out and say financial advice in general, even though that's not required on the license, but I would extend it out there. We need to give advice to clients as if that was our own money. We need to give advice that is in their interests and not in ours. And in return, we charge a transparent and an agreed upon fee. And it's usually expressed as a percentage of investments under management. And our job is to source the best possible portfolio construction and portfolio advice that we can for our clients at the best possible price, and
Within the
and
context of their plan and
within the
circumstance.
context of the plan. Yeah, that's
Yeah.
what independent advice looks like, versus walking into a financial institution, sitting across the table from somebody else, and them advising us with a perspective on how can I validate my job today.
Mhm.
I hate to be so harsh, but that's just the way it is.
Yeah.
And I think it's time for clients, for people out there, investors, to recognize that there's a better way based on working with an independent advisor, a guide by their side, rather than somebody who is in a cloaked adversarial position. somebody who is in a conflict of interest.
Yeah.
They are working for the institution that is selling the investments to the clients rather than working for the clients to create financial solutions that are in their better interest.
And I think one thing I love that we've done as a company and as advisors is in many cases, this requires us to lead by example. And we do everything in our own personal lives the same that we would reflect to our clients and advise our clients. Like we
For
hold
sure.
the exact same portfolios, we do the exact same work with ourselves, we give ourselves the same advice.
Yes. Yeah.
So when it comes down to treating our clients' money as it's ours, wait, yeah, treating our clients' money as if it was our own money, yeah, we are in the trenches. We are on foot with them also.
Absolutely. Absolutely. Yeah. Yeah.
Now, I know this is a huge rant because we are both very passionate about especially client interest and client putting our clients first. But when it comes down to fees, that we can't deny that they need to be controlled. They need to be managed. We see the impact of excessive fees on portfolios, and you know what? That's something we are trying to reduce in our clients' lives. We're trying to give them value for the fees they pay.
Yeah.
And we have something called the our value fee conversation.
Yes. I love
And
this
it's
conversation.
yeah, go
It's
for
great.
it. And I'm going to let you take over now because
I love
again, you just love talking about this stuff.
Well, I'm not gonna give everything away here,
Yeah.
right? Because I would really love to. Anybody that's interested, I'd love to have this conversation with you directly. Um, but it's our value fee audit checklist, and it's the thing that I love about it is it follows the fiduciary standard of looking at what is in the best interests of the people whom we serve. And Matt, let me ask you this: would it be valuable to you if you had a comprehensive financial plan that covers all 8 basic areas of finance? And by that I mean tax, estate and legacy, to make sure that you don't die broke, but you leave some substance behind, that you're covering risk management, and so that you don't so that you can survive a catastrophic loss, that you're covering your investment portfolio at a fiduciary standard, that your insurance portfolio is well managed and up to date, that you are on track to pay down debts and that they're structured in the best way, that your cash flow is sustainable while you are working and in your financial freedom years till your ending years, and that all of your group benefits and government benefits are all aligned together in one plan. Like, would that be useful to you?
Firstly, I think you're a little crazy here because I hear so much about these financial plans, but I've never actually seen one in my life.
It's you know what 51% of Canadians say they have a financial plan, but about a third of them or so, 40% or so, say it's in their heads. So
So
the truth,
from that
yeah.
perspective, of course it would be valuable if I had that document.
Of course, if only a third of people out there actually have a written financial plan, of course it would be effective to have a written, comprehensive financial plan. And to your other point that you made before about fiduciary advice that we were talking about, would it be valuable, like to you, Matt, if you had unbiased, unconflicted, best in class portfolio management advice that follows a fiduciary duty, that looks deep into your existing portfolio to see how it can be improved, um, giving you like transparent fee based advice so you know exactly what you're paying in dollars and percentage points, and that you're benefiting from value added services like tax loss harvesting, whereby you can use embedded capital losses in your portfolios to offset future gains. Like, would that be useful to you?
Wait, don't I have that already?
Ah, yes, you do. Okay, but let's just assume you don't yet.
Yeah,
Okay,
of course
Matt,
that would be valuable.
of course. So, like, I've got another question. Like, a financial plan is great, and most of the written ones end up sitting on the bookshelf in a nice binder, and they're awfully attractive, lots of colorful graphs and stuff, but there's no action plan that's being followed. Um, would it be valuable to you that your financial planning process included a progress plan where we regularly update you in our meetings and help you as a guide by your side to implement? And just like you're driving your car forward and you have a dashboard right in front of you with all of your metrics, would it be useful to have your own online progress dashboard and to have a checklist of the steps that you need to take right now, ranked by the ones that'll have the biggest impact, and that you're actually making progress one step at a time with somebody who can guide you in the most efficient way? Like, would that be of value to you?
Yeah.
Okay. And the big deal for everybody is having confidence in the future and freedom, that they can cut those checks for their experiences in their financial freedom years, and they may or may not be working at the time, but they have sustained lifetime cash flow projections, sustained lifetime cash flow that they can't, that they just can't outlive, that money is
Hmm.
going to be there for them. Like, would that be valuable to have that level of confidence?
Of course.
Okay. How about
So,
an income? Yeah. How about an? I'm going to give you one more. Okay.
okay.
And that'll be it, because there's a
Okay.
bunch more that we have. But an income tax review. When is the last time that your financial advisors actually reviewed your tax returns with you? It's something that we're doing regularly now. And that is because we want to find embedded opportunities to um, uh, to harvest any tax opportunities that we have for saving dollars. We don't want to pay through the nose in taxes. We want to legally find ways of reducing them and coordinating that with your tax professionals, using tax loss harvesting like we talked about. Like, would that be of value to you?
Hmm.
There you go. So these are examples of things that we go through in a value fee audit with people. And it's a refreshing review of the kind of advice you might be getting right now, comparing to the kind of advice that's actually in a fiduciary standard that you should actually be expecting from a financial advisor.
So, many of my responses were biased because, of course, we feel very strongly about
Oh,
this.
for sure. Yeah, yeah,
But at
yeah.
the same time, I think it's also important to outline for people, again, as you said, what you should expect out of a fiduciary standard of care towards your financial situation. But again, you notice how there's more to this than just the investments?
Hmm.
There's a lot to consider with an overall financial picture.
Yes. Yeah.
And I think in many cases, people don't realize all the pieces that need to be put together. And we like to refer to this as um, financial overwhelm
For sure. Yeah.
because it happens to everyone.
Hey, can I
Um,
tell you a story? Can I just butt in and tell you a little story? And this relates to a trip you and I and your brother Pete uh, took in 2011 to Europe. We met him in Pompeii, and Pete was there finishing his classical studies degree with his class, and uh, we ended up in Pompeii, and we arrived there, and I tell you, it was, speak of overwhelm. Like, there was a bunch of rubble as far as I could see. It didn't make any sense to us at all. But we had Peter. And even though we had no idea what Pompeii was about, its history or everything about it, Pete took us on a tour of that place and translating that rubble into real vivid pictures of what life in ancient Pompeii would have been like. And more importantly, though, he didn't just know his subject material, but he knew us and he knew how to connect us with the experience. So it's the same, it's similar with your finances. You need a trusted advisor who knows his or her stuff, and more importantly, knows you, and over time gets to know you even better, so that the quality of that advice will improve the longer that relationship stands.
Especially if it's aligned to your values.
For sure.
Yeah.
Yeah. Yeah.
So I think some questions people might have when it comes to professional advice, and maybe these questions are a good segue into you understanding if you need professional advice or not. I have 9 questions that we can go through, and if you don't know the answers to any of these questions, it might be time to reach out for professional advice to find a
For
trusted
sure.
advisor to work with.
Yeah.
Number 1, will I have enough money? Number 2, how long will my money last? Number 3, when can I retire? Number 4, when should I take my government benefits? Number 5, how much can I spend and not go broke? Number 6, when should I draw on my assets? Number 7, is my current level of savings enough? Number 8, how much will I pass on to my family? And number 9, will my family be okay if I get sick, hurt, or die?
Those are the big ones.
And number 10, bonus question,
Yeah.
will I be okay?
If you can just answer that one, that bonus question, I'd be a happy camper,
Mhm.
right? Hey, so what do people need to do to get going, and to get that kind of clarity that we're talking about?
Well, I think here's a good question to ask. What should people look at when they're looking for professional advice?
Mhm.
What are some characteristics that they need to keep in mind when they're looking for professional advice in your mind?
Number one, and this is a hard one to gauge, but it only comes from conversation. And that is the feeling and confidence that the advisor gets you. Okay. And that can only come from what we call a focus finder conversation. And we've had so many instances after a focus finder conversation when people have told us, you know what? We've never talked about this. And nobody's ever asked us these questions in that kind of way before. And even from this conversation alone, we've gotten immediate value. So that's number one. But the second thing is to know, uh, tell me about your process. Tell me about your financial planning process and the kind of value that you would expect to give us as an advisor. And that's where we would go through the value fee conversation with clients, with potential clients, anybody that's interested in engaging with us. And another thing that would be really, really important is to understand that as an advisor, you've done the work. There are endless numbers of financial salespeople who, either working for an institution, some even working independently, do nothing but sell financial products. But have you done the work in doing the studies to do your CFP, your Certified Financial Planner designation, to become licensed for the appropriate securities in which you give advice on? And I'll give you like one example. And I hate to pick on this area, but there are people who are purely only insurance licensed, and they're actually giving advice on securities, which is no, no, you can't do that. And yet they are licensed to provide access to segregated investment funds. And that's allowed. But is that in the client's interests if you don't really understand the underlying securities? Don't think so. So, are you fully licensed to provide advice on the underlying investments that you might recommend? So, again, mindset and heart set, understanding and having uh, care, consideration, compassion for the people that you serve, to understand where they're coming from Number two, a financial planning process that is robust and runs like a clock to help you achieve the goals that matter. And number three, that you are licensed and qualified in the areas of advice giving. Any that you could add there, Matt?
There's also going to need to be a personality fit. So you
Yeah,
might you might actually need to interview a few advisors and see if you click.
for sure. Yeah. And I'd say the best place to begin is like a hassle-free quick chat. People can click on the link provided and they can just schedule a quick chat with us just to see if there's a fit. Okay. And if there happens to be even a shadow of a fit that's worth exploring further, well, we can go down that road if you like.
Mhm.
But we have great scheduling software that just allows you to go in there, find an appropriate date on your calendar, and have a quick chat by phone or by Zoom.
Mhm. All right, and I think with that, let's wrap up this conversation.
Looking forward to the next one, Matt. Thank you so much.
All right, see ya.